let's talk about how your interest rate is making you house poor. That's right. And I'm going to give you 3 ways that you can be able to make sure that interest rates do not hurt you. So right now, you have seen it all over the news about us having high interest rates, and this is some of the highest in history. Actually, it's not. Let me tell you, just in the late 90s, we saw interest rates at 6, 7, 8%. And there's individuals that are still in those interest rates. And so I want you to know that with anything, real estate is a cycle, especially when it comes to also interest rates. It's based on the market. So it's going to go up, it's going to go down, it's going to does do what it want essentially, but it is tied to the market, which is why you always going to see different interest rates, right? But I want to break it down to you. So not only you know why interest rates are very important, but I'm also going to tell you why they're not very important here. All right. Because at the end of the day, my goal is so that you are not house poor. All right. You want to be able to keep as much money in your pocket, and I want to make sure you can do the same. So let's talk about why interest rates can be important. Now, the thing here about interest rates is that, as I said, they can go up, they can go down, depending on the type of loan you have. It's going to, determine your interest rate. But essentially, we all want the best the best interest rate, right? And we know that comes with the best credit score. But there are some times where you can buy down your rate and be able to have a better rate. Now, here's the good part about having a good interest rate. Your payments are lower, because the amount of loan that's being financed is financed at a lower interest rate. Just like if you had a car, right? If you had a car, you had a 10% interest rate on your car versus a 2%, your car payment is lovely, right? But mortgages are the same thing. So we're always looking for the best rate, the best rate, the best rate, right? But here's the thing I want you to catch, my friend. Whenever you're looking for the best rate, just know you're going to have to pay for it oftentimes. I don't care if you got bad credit, good credit, mid credit, I'm there credit, no credit. You're going to pay for a certain interest rate. Just like I told you before, interest rate is dependent on the market. One day, a 7% or a 6% or a 5% can be worth $0. The very next day, that same 5, 6, or 7% interest rate can now cost you $2,000, right? That's just an example, but that's how interest rates are. So whenever you get what is called a loan estimate, which tells you, information about your loan, how much money is due or you're getting back, what's your interest rate, what's your estimated monthly payment, these are your estimated closing costs, all the things that you need to know in order to proceed with your loan, right? To tell you these are preliminarily, these are the numbers, okay? So with that interest rate, you may see discount points, and those discount points is you essentially buying that particular rate. So when you see a lock, that means you have locked that rate in, and the price of what it costs, like I said, a 5% can cost you $0 or it can cost you 2,000 plus whatever, right? So let's just say you got a 5%, 2%. It costs you $2,000. Well, you're going to see that on your loan estimate of what it costs. But if that's not locked in that rate, essentially it can go up, it can go down, it does what it wants. But that's why whenever you get a good rate, you want to lock it in, okay? If you can, but have your ducks in order. If you're really about to go and purchase a property, you want to make sure your ducks in order. Always go back to listen to any other lives, okay? Don't worry. Go and ask me a question if you need to, all right? But I want you to understand that the first things first, interest rates, it can cost you. It may be $0 today, it may be $2,000 the next day, it may be $1,000, it may be $100. We don't know because the market continuously changes, and that is what interest rates are backed off of, the market. Okay, so now that I clear that up, all right, interest rates are good for you if you have the ability to have it low. It's bad in terms of not locking in a rate. It can cost you sometimes at the end of the day. So indecisiveness can stop you from, potentially getting a good rate. It doesn't matter. You can have a bad rate then, and it's not locked, and then it goes down to $0 the next day. It is dependent on the market. That's something that when you're dealing with financial institutions, that's what happens. Usually with other institutions, they have it built into their price, so you paying it automatically, right? But it still essentially is based off of the market. All right. And here's the thing about being house poor and having an interest rate. If you are in a place right now where a certain interest rate it just is not feasible for you to buy it down, or to have, essentially being able to take on extra closing costs on your loan in reference to the interest rate. Now, my friend, this is where you got to be strategic. Okay. So right now, let's say you're getting quoted at 6.5%, 7 some places, right? So if that's the case, you want to make sure that you're not house poor, which means you're still able to survive. You're able to pay your bills. If you will have more than enough to be able to pay your mortgage. This is why we do debt to income, because if most of your check is going there, then you're house poor, right? If most of your check is going there and you're struggling to actually live in that home and buy furniture, because you got to be able to actually live in the place that you're buying, right? If that all is too much for you, then you have to go back to the drawing board and make sure those numbers make sense for you, and have that discussion and say, hey, what am I paying now versus what I will be paying with this interest rate? Because even though interest rates go down, they can go up, they can go side, they can say where they at. But the thing is, can you sustain that for the next 6 months, 1 to 2 years? Because if you're waiting on the interest rate to go down, now it's kind of like a waiting game. But during that period, can you really be able to afford to make that payment? Right? So I'm talking to my purchasers out there. If you're buying investment property, same thing. The person that's going to be renting it, do they have enough to pay off the mortgage and put a little something in your pocket at the end of the day? Right? So just because the interest rate is low doesn't mean it's necessarily saving you in terms of closing costs, or over time, is it really saving you the money that you're looking to save from? And the reason why I say that is because sometimes when you get interest rates that are low, as I said before, you're going to pay for that. Is it worth you paying a certain amount, for that particular interest rate? Is it or isn't it? Because if you look at it like this, let's say it costs you $10,000 to buy down your rate, to bring your rate down from 5 to 3%, $10,000. But you can afford to have a 5% interest rate. Well, wouldn't it make sense to take the 5%? And I'm not telling you this is what you need to do. This is just an example. It can make sense, even if you take that lump sum and put it on the loan once you have the house and now you're making mortgage payments. And let's say you put that amount on your loan. Well, you can be essentially saving way more money, because now you shorten the length of time that you're going to pay for that mortgage. Now it may have went down from 30 years to 28 years just because you put the 10,000 instead of on the interest rate to buy it to bring it down, but you put it actually on the principal payment so that you could be able to bring the total loan down, which decreases your interest, right? So you got to be able to not just get in a mortgage just to get signed up. You want to be strategic with it because you're not trying to be house poor. So I'm giving you some options that's going to allow for you to be able to decipher, okay, is it best for me to put this to the side? And then if you go to my link, bit.ly link, you'll be able to go to my page and see all the calculators that's there. And I think one is on there for extra payment. It'll let you know how much you're going to be able to pay down in order to be able to save. Now you may pay 10,000 down, but you save 50,000, right? So that's a $40,000 difference versus just trying to have a lower payment. And sometimes the interest rates, your payments are only probably $150, $75, depending on, you know, what you're trying to do. But the payments aren't like this astronomical difference. And a lot of my clients get to see that because we create strategies depending on their lifestyle now and what they're looking to do moving forward. So it has to make sense now and in the future for you. Okay. So check that interest rate and see if it's worth buying or not. All right. That's very important to making sure you do not become house poor. Also, my purchasers out there that's ready to buy, I'm talking specifically to my investors here, okay? You have the opportunity to have interest-only loans. Do not, my friend, do not think that you're going to get a primary residence interest rate for an investment property. Not happening. Unless, once again, you buy down the rate. But we're not looking to do that. What we're looking to do is have it to where we have our property, and this interest only means you're not paying the principal amount on the loan for X amount of years, right? Depending, there's some that do 5, 7, 10 years, right? You're only doing interest only, which means you're paying interest, taxes, and insurance, okay? That is it. So your payment essentially is going to be lower. Sometimes what I've seen is that interest only rate can still compete with the 5% what a primary residence will get. All right. So depends on your loan, depends on the circumstances. Every loan is different. And I mean, every loan is different. But I've seen it before where even though it may have been an interest rate of 9%, it still was compatible with that. Now, if you're looking like, hey, I'm fine with not going interest only, and I want to have, a lower interest rate, then essentially you can use that strategy if you want to be able to maximize your cash flow. But as an investor, your goal, buddy, and any buyer, all right, your goal is to have equity, because it's going to be very important when it comes to in the future. And I'm going to tell you why here in a little bit. But here's the thing, when you are house poor, it's going to be very hard during that 6 months to a year or whatever that you're going to have to be in that loan up until it's time for you to refinance. So just think about it. Being house poor, meaning you are not able to do the things you need to do, but you made it into your house, right? But I don't want you to compromise your life, your lifestyle, your food, whatever that is, in order to get into a home. So be smart about it. Make sure that you have enough saved up. You don't have to do 20% down payment. And that's another thing. Instead of putting it on down payment, you can put it on the back end of the principal and still pay and have it paid down. There's so many different ways to besides just having a low interest rate and putting a lot of money down as a down payment. But as an investor, my friend, appreciation is very important to you. And that's also important for someone that's not investing, because at the end of the day, you want to keep more money in your pocket. More money in your pocket, okay? More money in your pocket. You essentially want to do that. So if you think about it, if you're house poor, you're not able to keep any money in your pocket because everything is going to the house. And thing is, if you're renting versus owning, nobody to just call and say, hey, come fix this because it's broke. That is your job now as a homeowner. And so that's why you want to be careful with how you allocate your money, especially at the beginning, because that essentially can possibly make you house poor trying to buy down an interest rate. All right. So for my investors, also, I want to throw this in for you. As an investor, you're looking to buy a house that could potentially have equity in the home, right? You're already looking for that equity, so you can possibly resell that house or be able to refinance. So also for my purchasers, same for you. You want to buy a house, and I know it's a little different for you because this is your dream home, right? This is the home you're going to be in the next few years. You're not really looking to capitalize, but of course you would like to make your money back if you decide to sell, right? So we're going to talk about refinances here. For a purchaser of a home, this is for you. When you refinance, you want to be able to have enough equity in there that there's two type of refinances you can do. And this is also for investors too, okay? This is just refinance in general. Two things that you can be able to do. You can be able to do a rate term refinance, which means just lowering your rate, right? Or a cash out. Cash out, I'm telling you, people feel like payday when it comes to cash outs, right? Because essentially you can pay off your debts. And sometimes if you have enough equity in your home, you can be able to pull cash out as well. That's for primary residences, okay? For investors, you got to pull, if you decide to pull cash out, it has to go towards business purposes. Can't use it to pay off your personal debt. All right, so that's the only difference between a primary refinance and an investor refinance. All right. But here's the kicker about purchasing your house or purchasing investment property. And this is the thing about interest rates. You can lower your interest rate by doing a refinance, right? But when it comes to a cash out, sometimes your interest rate may be higher. And then essentially you're looking like, oh my gosh, my interest rate has went up. Now I'm going to be paying more money. I'm in a 30-year loan again. And I feel like I'm back at square one. Here's the thing. You can use the strategy I just told you, buy down your principal of your loan. So your payments, so over time, you can be able to catch back up with where you was before. Making extra monthly payments towards your principal can essentially save you anywhere from 5 to 15 years off of your mortgage and hundreds of thousands of dollars, if not thousands of dollars off of interest. So just because you may be getting a new loan and feel like you're starting over, you are not. Also, let me tell you, if you're paying off debt, which is very strategic to do, not only are you helping your credit score, but also you are saving money, even with a higher interest rate. Because think about it. You have a 29% credit card, but you have a 5 or 6% interest rate on your home. The interest rate on your home is going to win all day. It's going to be a lower payment. So I've seen individuals, clients, past clients be able to save, and this is just their, everybody's different, but for them, they save anywhere from $8 to $20,000-$30,000 a year just by doing this. So just think about that. That's essentially more money in the household and better credit just because you've made a trade-off of a little bit higher interest rate. So think of it in this stance. If you don't want to be house poor, your mind has to think rich and wealthy. And how can I put money back into my household, right? So let's say, for instance, this is your strategy. I'm going to purchase me a property. Right now, interest rates are 5.5. I can be able to do that. I can be able to sustain this rate for 5 years, right? Thinking ahead just in case. If it takes 5 years for my equity to grow out, I can wait 5 years, or I can wait till rates go down and refi. 2 years come in and you just found out you have a whole lot of debt, right? So you bought all the stuff for your house and it ran your debt up, your credit cards, everything, right? And now you're like, oh my gosh, I'm in a position now that I have debt and I need to get some things fixed in my house. So you look and you see that your house is worth 300, your balance, is 300,000, but your house is worth 400,000. So now you say, okay, well, I want to be able to refinance. So with your house being at 400,000, we're going to times that by the maximum amount that you can get, which is about 80%. Sometimes you'll have it to where you can get more than that, depending on the loan program, but 80%, right? That's so you don't have to get mortgage insurance if you're doing conventional things like that. So you have about $20,000 available, minus closing costs out of that, right? So let's say your debt end up being $8,000, okay? 400,000, which is the new value of your home, minus 300,000, which is your home price of 80%, I did 80% of 400,000, right? It's 320,000. We have to pay off your mortgage, of course, that's 300,000. So that leaves you with $20,000. So I'm going to subtract out closing costs. I'm just going to say closing costs are $6,000. You're left with about $14,000. Now that can be enough to, let's say you only had $8,000 in debt. I think that's what we said, minus 8,000. And that's about $6,000 left over that you can be able to put in your pocket, right? So all debt is paid off and essentially is rolled into the loan. But because you no longer have that debt, now your score is going to be able to rise. You have about $6,000 in your pocket. And essentially, sometimes, as I say, you could be saving anywhere from $250 a month all the way up to hundreds of thousands of dollars a month, depending on your loan, depending on your equity, depending on a lot of things. But that's just an example of how you can be able to purchase a house now. You run into some problems, 2 years in, you got enough equity, you can be able to refinance, be able to pay some things off, help your score get better. Because now, let's say 3 years now come, you're 5 years in, you've been able to save, and you've been doing the principal pay down method. So now you've done built the equity back into your home again, plus another 50,000 has came onto the house. So now your house is worth 450,000. And so essentially you can be able to not only fix things in your home, but be able to help yourself out. Use your home as a vehicle, as an asset that can help you pursue bigger things in your life, that can help you get out of debt. And if you already own a home, I know how you feel about that interest rate you have right now. But essentially, you can be able to save just as much money. If you are drowning in debt, why drown in debt when you have enough equity to help save you and save you hundreds of dollars, if not thousands? Why not? Continue to put yourself in this position? And that's also what house poor is, not being able to do the things that you want to do and progress in life because you're stuck and you feel like it's a ball and chain with a home. And that's not the case. You can be able to use your home as an asset, not just a liability where it's taking money out of your pocket. You want to be able to have that as an investment vehicle to put money in your pocket. So your interest rate, it matters, but it doesn't. Why? Because it's all about your strategy. It's all about the things that you need to get done and what that looks like. Did you know that you can refinance as a primary residence? You can refinance your home and be able to go and get an investment property with that money, or start your business, or like I said, pay down your debt, be debt free. There's so much that you can be able to do. Fix your home up so it can value add more, so you can either rent it out or sell it. These are things that you can be able to do, especially if you already own a home. So interest rates, the way that it hinders you is because you're so tied to that number. When you got all this going on in the back that could essentially help you, or you feel like I need this and I'm paying more than I can really afford because my obligations have increased. So strategize, think about the things that's really going to help you out, that's really going to allow for you to use that home, even if you're living there, as I said, as an asset. And so for my investors, same thing. You can be able to fix the property up. You can be able to rent it out, rehab it, be able to refinance it, pull the cash out, go buy another property. Or you can do principal pay down, where you may take a portion of what your renter is paying and put that also on the principal, so you can build the equity up so that you can come and fix the house again and be able to chart, be able to keep up with the rental market. Don't just be passive when it comes to your life, your generations to come. Be strategic and push forward and be proactive. All right. So I just wanted to break it down about interest rates because I've had a few conversations with some clients about interest rates. I know that y'all out here feeling some type of way about these interest rates. So I just wanted to clarify, at the end of the day, I don't want you to be house poor. So go back, look into these cues, come and make sure you DM me if you have any questions. I would love to be able to answer them. But until next time, don't be afraid to DM me and message me. But more importantly, don't be afraid to move forward. And make sure you slay every day with style. All right, beautiful balls. See ya.